Good morning. My name is Miguel. This is Brandon, Katie, John, and Noah. We encourage you guys to power up your portfolio with the Southern Company, an industry-leading energy powerhouse, delivering clean, safe, reliable, and affordable energy. Its conservative nature, paired with both secular and operational tailwinds, lead us to issuing a buy recommendation with a 12-month price target of $76.70, representing a 12.86% premium relative to its 1-month volume-weighted average price. The Southern Company is a regulated utility serving over 9 million customers throughout the southeastern United States through its electric operating subsidiaries in Alabama, Georgia, and Mississippi, and natural gas distribution companies in Georgia, Tennessee, Illinois, and Virginia. Those segments make up about 80% of their total revenue. Additionally, they have Southern Power, their wholesale energy arm, as well as Power Secure, who specializes in energy grid systems and solutions. All these segments together generate 43,000 megawatts of diversified generating capacity. And moving on, the Southern Company consistently delivers superior risk-adjusted returns as it sits in the bottom 10% of beta levels within the S&P 500, with previous subject companies there for reference. Given the underlying characteristics of Southern, a majority of the shareholder return stems from the dividend, which is responsible for 52.8% of total return over the past 2 decades. These characteristics lead to a value proposition that attracts investors who are typically more risk-averse, seeking income-generating investments.
When looking at the utility industry as a whole, we see monetary policy playing a significant role. Rather than impacting their end consumer spending patterns or their bottom line via interest expense, monetary policy often changes yields, which has an inverse correlation with utility valuations, as you can see on this graph here. To get a better idea of the impact here, we looked at the last 30 years of 10-year Treasury yield data and found that the average utility price-to-earnings ratio was 24% higher when the 10-year was below 2.16% compared to when the 10-year was above 5.97%. Another important driver to mention is going to be inflation, as this has historically driven utility firms' top-line growth, as is represented by the similarities between the changes in the producer price index as well as utilities' revenue growth. Additionally, to get a little bit more granular, we looked at the relationship between Southern Company's dividend growth as well as the retail price of electricity growth, and found that 84% of the changes in Southern Company's dividend can be explained by the changes in retail price electricity growth.
Although it is not the only contributing factor, unexpected inflation can facilitate cost overruns, leading to minimized shareholder returns as capital is allocated towards associated costs rather than their dividend. Additionally, unexpected inflation can create budgeting challenges, which can be detrimental to the relationship between the regulators and the Southern Company. These relationships take years to build, and maintaining them requires constant trust and reliability, making going over budget a significant problem, as it can open the door for a potential lower authorized return on equity. To get a gauge on the health of these relationships, our team sat down with the chairman of Georgia's very own Public Service Commission, Jason Shaw, and some of his staff. As noted, Vogel 3 and 4 went significantly over budget, but upon speaking with the committee, we can affirm that the relationship remains strong. The Southern Company subsidiaries rank among the top companies in the nation with the highest authorized return on equity. As you can see, their electric utilities rank in the top 5 with Alabama and Georgia Power, and Atlanta Gas Light ranks at number 2 for gas utilities. The Southern Company has had, on average, a higher historical return on equity than its competitors, which can justify the premium. Over the past year, their electric territory has seen growth in both population and economic growth. This can be attributed to the growth in the state of Georgia, which can also be shown in the increase in the number of new large load customers. Additionally, as companies continue to choose Georgia for its immense generating capacity, leading to exceptional job growth, we can see that the 2023 Integrated Resource Plan has been updated to project these increased levels of demand.
Although growth is absolutely something you want to hear from the investor's perspective, this does raise questions surrounding CapEx and financing needs. With things like electric vehicles and data centers driving the demand for generating assets, Southern Company has revised their capital spending forecast upward rather significantly, with fiscal year 2024's budget growing at a 7% CAGR compared to 2020's initial forecast. However, when looking at the last decade of activity, we do see a balance sheet that has some leverage, with the acquisition of AGL here in 2016, as well as Vogel Units 3 and 4's investments bringing their net debt to EBITDA up by roughly 69% over the last decade. When looking under the hood at their debt structure, we do see them being hit with higher financing costs, as $5.5 billion in debt have been financed since rates began rising in 2022, sitting at a weighted average coupon rate of 4.88% or a market rate of roughly 4.99%, sitting at approximately 94 basis points higher than the remaining 63% weighted average coupon rate of their debt. However, when we look at the company, we do see the balance sheet headwinds beginning to subside as they shift away from more capital-intensive, higher-risk projects and refocus on less riskier projects, allowing for accelerated cash flow growth and less of a burden on the interest expense. It's also important to note that these projects that require financing have already been approved by regulators, and these projects have their respective budgets. When rates are expected to rise, they factor these into the cost that they charge their customers, and this is all ultimately reflected in their long history of consistent net profit margins, with two outliers, the first being here in 2017 due to an incident at the Kemper project, as well as in 2019 due to the sale of Gulf Power.
With regards to ESG analysis, on the environmental front, as we can see, Southern Company has achieved diversification in its energy mix as it pursues its target date for net zero emissions of 2050. As we see in 2007, 69% of that mix came from coal, and then in 2022, they have reduced it down to 20%, whereas in 2007, 1% came from renewables, and in 2022, that number was up to 15%. With regards to the social element of ESG, Southern Company has received numerous accolades for its commitment to diversity and community leadership, and then within governance, Southern Company has strong commitments to practices such as succession planning and regular board refreshment. And then also, as we can see with this list of the top 10 insider holders, we see that they own a combined 0.17% of shares outstanding, demonstrating management alignment with investor interests. Now, with regards to valuations, we took our assumptions from all of our research and we baked them into an earnings model, which enabled us to forecast the future earnings of Southern Company, which in turn fueled our three valuation methods: a fair value multiple method, an exit multiple dividend discount model, and a perpetual growth rate discount model, dividend discount model, which in turn fueled our price target. With regards to the fair value multiplier, we took that data from our earnings model and we compared it not only to Southern's peers, but also to its own performance in order to arrive at our valuation metric for that method. And then with our DDMs, our dividend discount models, we took the earnings per share numbers from our earnings model and then applied a historical payout ratio to it, and then took both in order to get the dividend per share, and then took those figures plus the terminal value and discounted those back to the present value using our discount rate, which was the cost of equity calculated using the capital asset pricing model, in order to get our intrinsic values from the perpetual growth rate, where, by the way, we used a 3.5% historical earnings growth rate, and then our exit multiple method, which we got using a 10-year average PE exit multiple of roughly 18 times. Then we also conducted two sensitivity analyses to test key variables within our models in order to see how external factors would ultimately impact our valuation of the model, our valuation of Southern Company in our perpetual growth rate dividend discount model.
Southern Company's risks are mitigated due to their conservative nature. However, this might hurt them when it comes to monetary policy. When it comes to monetary policy, this is due to the fact that when in an environment when bond yields are higher, investors may be more likely to invest in those as opposed to Southern Company stock. This also hurts them when it comes to the cost of capital, as we mentioned before. However, this is mitigated through their consistent and strong dividend, increasing investor returns, as well as through their fixed rate financing, which reduces the impact of cost overruns due to operational inefficiency, which hinders their ability to maximize their authorized ROE. And this is mitigated through Vogtle Plant 4 completion nearing, which will increase their base case, as well as through rate approvals for cost overruns, which will likely be approved due to their great relationship with the PSC. We issue a buy recommendation for Southern Company with favorable secular and operational tailwinds, powering up our price target of $76.70 and 12.86% upside. Thank you.
Questions?
Yeah, just for question, how did you come up with this recommendation of $76.70? And could you talk about the different methods and the outcome and how you eventually kind of weighted average and you came up with that number?
So just to be clear, how we chose our weightings and then
Yeah.
some details on them?
Yeah, the 60% for the multiplier and then 15 and 25.
So just to start, just to preface, we weren't able to do a discount cash flow model due to the lack of free cash flow present within Southern Company. So we were left with alternatives, and we chose to do the two dividend discount models due to the importance of their dividend from the investor's perspective, and the multiplier method because that allows us to factor in things like interest rates, inflation, regional activity, whereas we can't factor those into things like a dividend discount model.
Okay, so that's why higher weightage to multiplier and slightly lower to these?
So yes, we rated that slightly higher, or rather higher, due to the fact that it incorporates more things that are relevant to a utility, whereas the other valuation models are focusing on one aspect of the business and trying to incorporate other variables to get to that outcome. But we just have more control over what we're factoring into our multiplier method
Okay, thank you.
to give us a more accurate price target.
You mentioned a couple of past acquisitions and how that impacted the company's financials. Given that we are in a higher interest rate environment and the M&A activities has become lower than history, would you think that there's anything you would want to do in incorporating the future M&A activities into your financial models?
So we do not expect them to make any major acquisitions given the current state of leverage on their balance sheet. We also hear commentary from their CFO and CEO hinting towards wanting to delever their balance sheet to maintain their investment grade rating. So we expect them to prioritize that side of their business rather than growing through acquisitions, especially when you have favorable tailwinds with population growth, electric vehicles, data centers, and things like that.
Thank you.
You mentioned you couldn't use this year because there was a negative free cash flow. Do you expect that picture to change in the next few years?
I didn't hear the first part of that question, I'm sorry.
You mentioned that you couldn't use DCF valuation technique because the free cash flow was negative. Do you expect free cash flow to become positive over the next few years?
Over the next few years, probably not, due to heightened CapEx continuing to grow their generating assets. However, over the long term, we would potentially expect them to begin generating free cash flow. But because of the nature of utilities and the constant need to be investing in reliability and maintenance, etc., free cash flow is certainly not in the near future.
It is also important to note that they just completed their Vogel Plant 4, and that was something that was increasingly eating away at their capital expenditures. So as we see that not continuing, we believe that their bottom line will be more reflective of a free cash flow.
And just to emphasize that negative free cash flow is a norm in this industry. It's been negative for over 10 years, including its competitors as well.
In terms of the debt equity ratios and how much leverage that they have on their balance sheet, how does that compare with the comparable companies?
It's a great question. I will reference our metrics chart to kind of give you a high-level overview. You can see on here. So are you asking specifically about debt to equity, or are you asking just about leverage in general?
I mean, yeah, you can use any measure for that. Yeah, just
So
higher leverage.
Southern Company does have higher leverage relative to its competitors due to some of these undertakings recently. However, it's not a meaningful difference. Generally, these companies do carry a healthy amount of debt, as this is actually optimal for them. It allows them to have the most efficient capital structure rather than taking out equity. But that we are aware that they have a higher leverage than their competitors, but in terms of the specifics, we do not have any data on this presentation.
And just one last thing. So you have you're predicting a price upside of 12%, right? why do you think that the market is currently underpricing and that the price could go up?
I think the best answer to that question has to do with the lack of understanding of the trends that are going on and the lack of understanding for how long these trends will be existing. So things like data centers, things like electric vehicles, these are long-term secular trends that haven't fully materialized. There's been some excitement recently, but that has found its way into more tech-oriented businesses rather than something like a utility. And you also have the recent increase in interest rates playing a significant role at the valuation they've been trading at recently. And with interest rates, people are speculating that they could be cut in March. People are speculating they could be cut in 2025. I think that is causing some uncertainty around where this thing should really be trading at. And rather than trying to be interest rate timers, we decided to look at the longer term and price in growth due to the secular tailwinds rather than trying to time interest rates.
Okay, thank you.
Yeah.
What was the total cost of the plant Vogtle versus the original?
So in reference to Georgia Power or the total price?
The total.
35 billion.
35 billion.
35 versus what was the original estimate?
Initial is 14 billion in 2009.
Okay.
And that was for both plants.
And what was, that's a pretty big miss, obviously. What was the backdrop to that?
There's a number of reasons you can attribute it to. I think one of the first would be the fact that it's the first plant built in the last 30 years. So it's kind of taking on a challenge that hasn't been taken on in a long time. And you also have things like inflation recently that have moved their budget up by roughly 20% starting in 2022. But it's a number of things, but by far the largest contributor is going to be the lack of understanding and knowledge when taking on a project like this.
It's also key to note that one of their operations companies that they were working with went bankrupt around the beginning of the period of building the Vogtle plants, so that affected them extremely in their cost for that.
I also wanted to mention that they actually submitted an application to the PSC to cover some of those cost overruns, and much of that was covered. I believe they recovered
7.56 was
$7.56 billion from those overruns for Vogtle Plant 3.
And just one other thing to add on to that, as the longer it gets delayed, the higher the financing costs will be. So the longer this takes, the more expensive it is, just because of that fact alone.
And one other thing to add to that, not many people know, but the Vogtle plants are actually a conjunction of many owners, and about 40% is owned by independent owners that are non-regulated utilities, and then around the rest of it is owned by Georgia Power, but they are not taking on the full cost of the plants.
Can you talk about, I noticed you used PE exit multiple of 18. And after you had a very interesting graph where you looked at the last 30 years and you said based on interest rates, that's what the PE multiple was for the company. So how is PE 18 compares to the historical period?
That's a great question. So we do have a graph here that does have, this is the most amount of data we could find on this company tracking its historic price to earnings ratio. And you can kind of see it since 2001, it does hover between 15 and 20 roughly, with changes often dependent upon things like their execution with Vogtle, as this has been going on since 2009. So that has been a massive, massive overhanging in terms of where this company should be trading at. And you also have things like the change in interest rates impacting investors shifting their money away from utility equities into fixed income, given the heightened risk versus reward. So it as of right now, I would say 18 times is a premium. However, when you put it into trailing terms, it's about average.
And it is important to note that in 2001, that jump in their PE multiple was due to the Enron scandal and increased regulations for utility companies. So that's why the average accounts more for after that period.
How does the company compare with their competitors on the ESG front?
With regards to the ESG front, if you could bring up the comparison metrics, we relied on several key ratings agencies, and we found they're usually middling.
We're at time.